Welcome to another Coffee with Samso, and where we speak to ASX companies and CEOs and MDs of their companies. But today we've got Rick Rule from Sprott Management. Rick, as we've talked before, probably almost going 12 months ago now. We've had two sessions. And Rick is kind enough to come on Coffee with Samso again. Welcome, Rick. And look, Rick, the last time we spoke was in March, April last year. We were sort of just realizing the world has changed dramatically. But I think since then, the world has sort of gone for the better or the worse on the equity market. Can you just give us a quick your view, your thoughts of what's happened the last 12 months?
Well, I'd begin by saying I hope people who listened to us in March took us seriously and did what we asked them to do. There was a suggestion that the precious metals market would improve. It did. And there was a suggestion that the industrial materials market would improve, and it did. So that's a very good thing. Also, we had the very good sense not to talk to each other in the fall of last year, when the precious metals market began to decline from oversold peaks. So probably the timing for this talk is pretty good. I guess the macro questions that sit in front of us will be, will the US government, to the extent that they're able, continue to allow the interest rates to rise? The strength in US interest rates in the last 3 or 4 months have obviously been very damaging to the gold price and in turn to the US equities. One wonders what increased interest rates in the United States in particular will do to the US economy, to the extent as an example that if the doubling of the interest rate on the US 10-year Treasury were to follow through to the prime lending rate and raise the cost of capital for industrial companies, were it to cross over into the 30-year mortgage rate and lower the affordability of homes, and were it to impact the cost of financing of, as an example, new cars, never mind federal, state, and local debt, while that would be damaging to the broad economy, any efforts to bring them lower would be good for gold. So I think that your readers and listeners, to the extent that they can, need to focus in particular on interest rates in terms of a discussion around natural resource investing. I suspect the second thing that they need to do, because I need to say that the strength of the economy globally is much stronger than I would have imagined. My own reading was last year that the hangover, if you will, from the impact of the COVID on economies around the world, and also the natural hiatus of a 10-year recovery from the 2000 events, would have meant that the global economy would have been, in my view, much weaker than it has been. I suspect that the economic strength that the world is enjoying is a function of artificially low interest rates and artificial liquidity. That is to say, it's a false boom. But I've been wrong before. Your listeners will need to make up their own mind as to the direction of interest rates and the relative strength of the economy. And they'll need to take any remarks that you and I make with regards to investments in the context of their own economic forecasts.
I remember when we had spoken, you did touch on the fact that if this had not happened, the recovery would have been much longer in the sense. So going forward, like, you know, look, in terms of what's driving the commodities market, not to say, you know, IT, and that's another sort of sector. What with the EV, suddenly there's a lot of this talk about, you know, EV, especially in lithium price sort of took off probably late last year somewhere, and it's driven a lot of lithium EV related businesses. What's your thoughts on that? And do you think this is long legs or short legs?
I think it has long and short legs, which is to say, in the very near term, with regards to lithium as an example, but the battery complex as a whole, it's overbought. People are buying narrative. People are chasing the EV story and the battery story without recognizing that, as an example, the stimulus afforded by electronic vehicles and even the stimulus afforded, by batteries and the electrification of the world is overbought right now. I suspect that people who buy the best of the best companies in the battery metals and lithium space will be very happy 3 years from now and 4 years from now. I suspect they'll be somewhat less happy 6 months from now. Lithium is a classic example. I'm long-term a lithium bull, but the idea that we have a shortage of lithium in the world reflects an ignorance on the part of the people who suppose that of geology. What we have is a shortage of processing capacity in certain lithium chemicals. The second largest lithium producer in the world, as an example, SQM, the big Chilean lithium producer, suggested at current consumption rates, they're down to about 85 years of reserves. What they have is a shortage of processing capacity. I believe that lithium demand will grow, and I believe that the lithium price will go up. I also believe that the primary beneficiaries of that will be the largest producers of lithium today, who don't need to go find deposits. They don't need to develop deposits. They only need to debottleneck their supply chains. I suspect too, and to a greater degree, the narrative around battery metals and rare earths will change. What's important to know in those minor markets is that the companies that matter in terms of supply of those commodities are companies that are large enough that the prices of those commodities don't matter to them. If you, Noel, were a purchasing agent for a technology company and you were going to buy some rare earth that's unpronounceable to me, and you had your choice between unpronounceable resources on the ASX or BHP, you would choose to buy from BHP because you needed security of supply. The consequence of that is that BHP will be extremely important to that material, but that material will be unimportant to BHP. So it's important that your listeners who are interested in the EV narrative and the battery narrative pay attention to the EV arithmetic and the battery arithmetic too, and understand the nature of the markets that they propose to dabble in, rather than just the narrative of ever increasing materials prices occurring as a consequence of electrification, electric vehicles, and battery technology. I think an awful lot of money is going to be made in the 5-year time frame, and an awful lot of money is going to be lost in the 1-year time frame. And the losers will be speculators who buy narratives without understanding what they're making. And the winners will be longer term oriented investors who pay more attention to fundamentals and less attention to big picture stories.
Yeah, I've been sort of saying to people, you know, geologically, there is no shortage of lithium. And I think, you know, you hit the nail on the head there. You know, the narratives always drives the bull run, and everyone's run in on it. And then the next narrative comes, everyone hops out of that and jumps on the next one and right. Jumps on that next wagon, right?
Right.
Which again, actually, you touch on something that I forgot to mention is rare earths. I mean, suddenly with all this, you know, the new Cold War thing that's happening, and obviously in China, they've had this monopoly over rare earths for many decades. Do you see that changing?
I don't think I do, actually. I think the rare earths story is an interesting story. But as you know, Noel, rare earths aren't rare. They're substantially more abundant in the earth crust than gold. The United States at one point in time had a thriving rare earths industry, including the world's largest rare earths mine at Mountain Pass. As the Chinese production in Xinjiang came on, the Chinese were so efficient at producing rare earths and discovered so much of it that they drove the market down to levels where other places in the world couldn't compete. several things have changed. Demand for rare earths has increased substantially, but at the same time, the Chinese citizenry's willingness to tolerate the environmental depredation that happened in far Western China as a consequence of rare earth production has declined, and the Chinese government's need to condone despoiling the environment is much less than it was 30 years ago. So as the Chinese adopt more responsible mining practices, their costs of production will increase at the same time that demand for rare earths increases. Any big piece of Archean or Proterozoic terrain in the world that has a decent pegmatite population is a great place to look for rare earths, including prominently, of course, Australia, but also the Canadian Shield, Brazil, Central Africa, Siberia. To the extent that the Chinese or the market substantially raises the price of rare earths, we'll find out just how unrare these things are. And somebody who succeeds will likely make an awfully large amount of money. To the extent that saner heads prevail and the Chinese manage the market for rare earths, and importantly, rare earths processing facilities, what I think you'll see then is a much more rational market. But again, to the extent that we see an irrational market, my suspicion is that ultimately the economic winners will not be the Toronto Stock Exchange or Australian Stock Exchange penny dreadfuls who are merely looking for rare earths, but rather they'll be major mining companies that have projects in their databases or are able to change capture mechanisms in their waste streams to capture rare earths that are currently flowed onto dumps because the prices are too low to encourage recovery technologies. Certainly, were I looking for who would be the immediate beneficiaries of the boom in rare earths, I would look to Norilsk, I would look to Vale, I would look to the companies that were producing multi-commodity flow streams, particularly in mafic and ultramafic deposits in Archean terrains, and look at their ability to recover rare earths from their byproduct stream.
Yeah, that's great, because it's again one of those things that are floating in the market now, and again, like I fully agree, rare earths are not very rare in that sense. And I believe, like you mentioned with the EV, it's the processing, how you deal with that, that's going to be the big player going forward, because there's plenty of lithium, as we all know, right? And look, I remember our conversation, and you mentioned people buy gold for insurance, and I keep telling people, my wife's friend Rick Rule said this, and when the silver squeeze came, and everyone's asking me, oh, do you know all these companies? They all happen to be silver companies. I said, well, my friend Rick Rule said that when gold is running, people are buying it for insurance, and when silver's running, that's when greed is in the air. Is that true? I mean, how do you?
I think we've seen a textbook example of that in the last 4 or 5 weeks. My experience in prior bull markets, Noel, and I wouldn't describe myself as a market expert. I would rather describe myself as an old guy with a good memory. My experience in prior bull markets has been, as we said, that gold moves first because the buyer's a fear buyer. When the narrative has been demonstrated by increasing gold prices, silver starts to move. It moves later, and remember, it took 18 months to get going this time. But when it starts moving, it moves further and faster. It does that for a couple of reasons. First of all, it's a more volatile metal, and it attracts the speculator or greed buyer. The second reason is that as a store of value, particularly in South Asia and the Middle East, where many of the prospective savers don't have enough dollar-denominated savings to afford gold, the lower unit price of silver affords them the same sort of measure of safety that gold does for a lower unit cost. And the combination of this incredible upsurge in demand that you see, particularly in South Asia in the silver bull market, with the momentum style speculators that you see in the developed nation, means that silver bull markets generally surprise us both by their duration and by their dimension. What we saw in the last 5 weeks has been something very different. We saw a whole series, and by series, I mean millions of small speculators who came to understand that short positions relative to floats was an investable thesis. You didn't need fundamentals, supply and demand arithmetic, so much as you needed market structure. The idea that, as an example, GameStop, which is in a business that probably becomes extinct in 5 or 6 years, reselling physical video games when they can be purchased online with no production cost, that the fact that that company had more shorts outstanding than there was free trading float to cover meant that that in itself was a fundamental. The market structure was a fundamental. I think that the people who understood that part of the market took a look at silver and took a look at the fact that the futures market often in a day trades more than 200 times the physical silver available for good delivery on the COMEX, and said this has the potential to be the most shorted metal on the most shorted market on the planet. I think those young people need to recognize that the market capitalization of the silver futures market is much, much, much greater than the market capitalization of GameStop was. So their ability to corner that market is less. I think they need to recognize, too, that the COMEX exists to serve itself. And to the extent that they caused real trauma to COMEX market participants, like the Hunts did in the 70s, that the COMEX can change the rules. They could increase margin requirements. They could even cash settle, which is to say you don't have to settle for physical silver, but you could suspend the market and then say settle at market where there was no market to settle at, and set an arbitrary price for the settlement of long and short interests. What I think has been done in the last 5 weeks that is of use to the silver market is it has introduced absolutely millions of speculators to the whole silver thesis. And as the youngsters in Reddit inevitably move on to a different adventure, my suspicion is that several million of them will stay in the silver market to the benefit of the silver market. They have also, with their purchases of some silver equities, but also physical silver, rather than their positions in the silver futures market, actually succeeded in tightening up the silver market. Had you and I had the discussion that we're having today 6 weeks ago, I would have pointed out that Sprott, as an example, over the last 12 months has probably bought 30 million ounces of silver, physical silver, for our silver trusts. And we experienced absolutely no supply shortages. The shortages occurred in retail products, in ounces, in 10 ounces, in kilos. This occurred both because the demand exploded at the same time that the refiners were shut down because of COVID, and they couldn't take 1,000-ounce product and make it into 1-ounce product. But we, buying a wholesale product, experienced no silver market shortages. In the last 6 or 8 days, I hear that the physical markets at the wholesale side have become tight too. This isn't something that I've ever seen in 45 years in metals markets. So it's interesting that many millions of small investors have actually tightened up a market that is the size of the silver market. And what's of interest to that is if we begin to have a circumstance where the tail does not wag the dog, meaning the futures market does not drive the price of the physical, but rather the physical begins to drive the futures market, we will have a very, very different market indeed. Is this a forecast? No, this is merely an observation. But what has happened in the near term, well, the reasons for it will likely move on. The impact of it is likely to be much further reaching.
That's interesting. I've actually never looked at the silver market until actually talking to you and suddenly realizing that there is, and everyone's actually been saying they should look at the silver market, but which leads to my next question. I mean, obviously, Dr. Copper is doing really well, and our friends at Hot Chili, which is I really love the story, are going to benefit. But do you see that? I mean, obviously it's broken out and everything else, and he's been threatening to do this for many, many years. Can you give your thoughts on that side of things?
Well, I'll begin by saying a year ago when we talked, to paraphrase the American country singer Patsy Cline, I was so wrong. I believed that the economy that we're in would be substantially weaker than it was now. And I believed that the weak copper prices that existed in March would persist until today and beyond. The injection of so much liquidity around the world, but particularly the injection of liquidity in China and the continued urbanization of China, has meant that we are having the type of supply shortages in copper that I would have envisioned us having in 2024 or 2025. I think your view of copper is necessarily driven by your view of the economy in the near term. If you are afraid, as I am, that we are having a false start in the economy and that commodities prices are at least partially narrative driven, which is to say the reflation trade, then you're going to be cautious about copper prices in the near term. But as we discussed back in March, Noel, in the longer term, in the 3-year time frame, in the 4-year time frame, we have underinvested as a society in productive capabilities and industrial materials, including oil and gas and copper, for at least a decade, and I would argue for 3 decades. And there are impending supply shortages 3 or 4 or 5 years out that I would suspect are inescapable. So my nervousness around the copper price has nothing to do with the year 2026. It has a lot to do with 2021 and 2022. And thus far, mercifully for all of us, I've been way wrong.
When we spoke before, and now that you've talked about the false start and the liquidity that's come into the market, and I tell people I haven't seen this kind of liquidity, you should use that word, since, or activity in the exploration sector, since probably the 80s. And there's so much money. One ASX guy told an associate of mine that late last year, there was 80 companies that are waiting in the wings to come in. And if you work at the minimum raise of 5 million, that's 400 million that's coming into that sector or general sector. That's a lot of money in there. So again, coming back to our discussion, whether this next run's going to have long legs or short legs, I seem to think that it's manifest itself because there's so much money, you just need to spend it, by the lifestyle companies, right?
Yeah, I think I understand the nature of your statement. My nervousness is that the Australian dealer community and the Canadian dealer community are capable for a fee of printing enough share certificates that almost any demand that you would see in the junior market could be swamped with new issuances. I always make fun of the government's ability to counterfeit, but the truth is that the private sector can do anything more effectively than government, including counterfeiting. So over time, the Australian dealer network and the Canadian dealer network will produce more phony share certificates than the market can absorb, and the market will collapse of its own weight. Certainly, we saw that in the junior sector beginning in June of last year, where the flood of new issuances, irrespective of the rise of metals prices, was such that the market in and of itself went into a stall. And that stall was exacerbated, of course, by a falling US dollar gold price. It's important, Noel, that speculators recognize that the best of the best juniors, which is to say maybe 15% of all listings, will, in my opinion, be materially higher, not just higher, materially higher 2, 3, or 4 years from now. My suspicion is in bull markets or bear markets, the majority of the listings on all exchanges, probably 80% of them, have no economic value whatsoever. And they will try to return to their nominal economic value, which is to say zero. What you talk about in terms of equity liquidity in the market today is, as you would suggest, absolutely incredible. Very recently in North America, Haywood floated a secondary from Denison Uranium, a sector that until recently was a pariah. They stopped circling on that order when demand exceeded supply 8-1. This in a sector at $30 a pound that's currently uneconomic. The idea that if financing was 8-1 oversubscribed, speculating on an event that might not take place for 1.5 years or 2 years, is troubling. Let's just call it troubling. There are other circumstances, and I don't want this to be construed as a stock recommendation, but there are other circumstances where there are companies like the aforementioned Hot Chili that have been real examples of perseverance, never mind surviving, but thriving in a very bad copper market. And in those circumstances, where you see a deposit that's gone from a marginal tier 3 deposit to probably an upper tier 2 deposit and is knocking on the door of tier 1 and still hasn't received as much investor love as one would suspect, the juxtaposition of those, and that's no criticism of Denison, by the way, I'm long Denison, but it really says that investors and speculators in the junior part of the sector have to focus on stock selection. They have to focus on geology. They have to focus on finance. They have to focus on arithmetic. And they have to, for the most part, regard narrative, if they regard it at all, as icing on the cake, but not the cake itself.
Yeah, I like that, because that's what I've sort of been saying, that even with the run last year, that there were so many companies that were getting humongous rise. 1,000% was the norm. 500 was you're doing okay. 200, what's wrong with you? And I kept telling people, you got to find that's exactly what you've said. The solid fundamentals, like you wise men have always been saying that's how it works. Like your counterparts, Warren Buffett's always said, if you don't understand the business, don't go any near it. But there's a lot of casino players out there for this kind of play.
And it's good that you call them casino players, because their odds of success are very similar to their odds in the casino. When you walk into a big fancy casino, what you need to understand right away is that building wasn't built by winners. It was built by losers.
Yeah.
If you own a share of a stock, it doesn't matter the domicile. And it goes in very short order from 10 cents a share to 50 cents a share without any change in the underlying fundamentals. Although you're happy about it, that stock is precisely 80% less attractive than it was before it ran. The fact that the price of something goes up when the value doesn't increase at all is bad, not good. And you need to remember in circumstances like that if the stock has gone up by 500%, you aren't wealthier unless you sell.
Yeah, that's and there's a famous saying: you don't go broke taking profits.
Correct.
No matter what that profit is, it's still a profit, right?
Yep.
Look, that's one of the things that going forward in terms of a lot of people, there's a lot of small players, because of most small caps, and obviously, like you've mentioned, there's a lot more retail people in the market today than there was 12 months ago. I didn't think that much of Reddit until recently. Like with Sprott Management, like what you guys do, is that how do people sort of reach out to sort of get in that safe mode, or are you sort of the portfolios need to be much bigger?
Well, I mean, our typical minimum is 50,000 US dollars, but you don't need to open an account with us. You could buy one of our exchange traded funds on the New York Stock Exchange, or you could buy one of our physical precious metals trusts on the New York Stock Exchange, or you could own us. Sprott itself is public and trades on the New York Stock Exchange. And so the minimum investment in Sprott rather than with Sprott is the smallest amount that your cell phone will take. And many people have decided, particularly younger people that don't meet the minimum threshold for opening an account with Sprott, that the consequence of that is that rather than opening an account with Sprott, they'll just buy some. Parenthetically, by the way, that means that rather than us charging them a fee to manage their money, they'll receive a dividend from us and be diversified across all of our managed products, which is probably not a bad decision for a young person.
Small cap players don't know what dividend means.
They need to learn it, you know.
Yeah.
My friend Doug Casey once described earned dividends as outward manifestations of inward grace. Meaning that the company was healthy enough that it could pay a dividend and was polite enough that it returned surplus capital to the owners. So it's something that I understand that many young speculators don't understand. And I think that they will learn about it to their chagrin. All the lessons, all the narrative lessons that the young Reddit Robinhood speculators are learning today, I learned in my 20s. The good news is that they can learn it cheaper and easier than I could. And on balance, I think that what they're doing is a very good thing. Learning about investing, learning about speculating. Yes, the lessons are going to be hard. You know it, and I know it. But the idea, as an example, that the process by which information is distributed and consumed is becoming democratized. When you and I were young men, this information came from investment banks, which let's just say had an interest in what they told us. Or it came from major media outlets. Now the information comes from 10,000 sources, yourself included. And it's coming to peer-to-peer. And the fact that the access to information is democratized, and the fact too that knowledge itself, facts are ubiquitously distributed by Google. You don't have to know, you just have to know how to know, means that what young people have to begin to figure out how to do is how to obtain and how to analyze data. And there are many, many, many points of discussion which can only be helpful.
Yeah, look, Rick, you know, I think the discussion I really like is the fact that you're sort of sharing your many, many decades of wisdom on how to do things. For a lot of these retail guys, I mean, when I went to the last RIU conference, you know, I made 4 fans, right? They came up to me and introduced themselves, and
that's great
with the guys there. That another one, and I won't be able to fit through the exit door, right? My head would be so big. But I mean, look, I think the last 12 months have been really interesting. It's been good for geos, and everyone's got a job and everything else, but again, it's as we've discussed, it's sort of a sea of things that could go wrong, right? If you take the wrong position or too big a position, and like you said, it's sort of a false start. To finish off, you know, what is your words of wisdom for these guys? Because I'm seeing tin price rising, and tin price is doing extremely well, but I don't quite get why that is the case. And obviously copper we've just discussed it, but yeah, in going forward, you know, what is your words of wisdom? How do you attack this, and how should you position yourself?
Yeah, that one's easy. Your listeners aren't going to like it.
Yeah.
Warren Buffett once said that you shouldn't buy a share of a stock until you had done enough work understanding the value that you would be delighted to see it fall 30% in price after you bought it, so that you could use the same knowledge to buy more cheaper. Now, sadly, Noel, I've been tested with that thesis dozens of times in my career. But If you decide to buy a share of stock for a dime, you should ask yourself how you'd feel if it was selling for 6 cents next week. If you would be delighted because you could buy more cheaply, then you should buy that share. If you would be horrified because you had, quote, lost 40% of your money, that means that you don't know enough about the value to buy the stock now. People pay slavish attention to share prices because that's easy information to get hold of, and nowhere near enough attention to value, which is much different. But money is made on the delta between price and value, or price and future expected value. So if you don't have an opinion about the value of something, the intrinsic value of a company, the net present value of prospective future cash flows, the price information is useless. If you apply the Buffett test, which is a very hard test, and by the way, you aren't always going to get it right, but if you aren't willing to apply the Buffett test, you need to be extraordinarily careful in these markets. And you only need to buy these markets when they're washed out and unpopular, when you are probably less interested in doing so.
I think that's a fantastic way of making it more sophisticated to my way of thinking. I tell people that you should go in, story in, have a story, you like the story, you're in for the story, you ride with the story until the story change. And I like your comment about, if it dropped 30%, you buy more, because like you said, yes, that's happened many a time. And he goes, well, and I felt, I'm happy you said it, because I feel smart now, because I used to buy it because, I'm averaging down now. I went from looking up to averaging down, but I think that's a good way of phrasing it, right? That you are confident enough to buy more at a cheaper entry price.
Let me tell you a wonderful story that's Australian-centric to illustrate that. Many years ago, 1998 to be exact, I became enamored of the uranium thesis, which was then even more extreme than it is now.
Yeah.
And I was in Australia at Diggers and Dealers, and I won't describe the entire experience for reasons that you understand. But I came across a then young man in the uranium business named John Borshoff with Paladin. And nobody went to his booth for 3 days. Nobody went to his booth, despite the fact that he's a very nice guy. And the more I talked to him, the more I decided that Paladin was an appropriate uranium vehicle, precisely because John Borshoff was such a fanatic about uranium, and so was I. And so I did something that I'm proud of today. I bought a bunch of Paladin when nobody else would. In fact, I wrote the check that saved the company at 10 cents. And the price went from 10 cents to 12 cents, I thought, because I'd made a fortuitous buy. Actually, it went from 10 cents to 12 cents because some guys thought I was smart and bought after me. But then from 12 cents, it went to 11. Okay, 10. Okay, 9, not so good. 8, less good. 7, lousy. 6, worrying. 5, 4, 3, 2, 1. At a penny, when your average is at 10 cents, you don't have a hold. You have a buy or a sell. You have to revisit your premise. I did, and figured out that I was right and the market was wrong. And I didn't get any at a penny, but I got some at a penny and a half. So the hard news was that despite my genius, my supposed genius, the stock went from 10 cents to 1 cent, which told you how much of a genius I was. But then the consequence of that is I revisited my premise. And in 6 short years, that stock went from a penny and a half to $10. That tells you a lot about illustrating the point that we just made. Prices are near-term phenomenon, and they're only useful information to the extent that you have an opinion on value.
Yeah, fantastic. You just make me a lot more smarter to some of my associates.
Well, they probably won't. They'll probably erase the whole interview based on that story. But
Look, Rick, thank you for giving me your time. I mean, we've had some difficulties trying to get ourselves together. I'm still waiting for that face-to-face with you. You mentioned November last year. Might have to wait a little bit longer.
yeah, my hope had been that your country was foolish enough to let Americans in sooner than that. But You're wisely protecting yourself from Americans. COVID is the excuse you're using, but there are probably more valid reasons to do so. In the interim, what I'd like to do is offer an inducement to your listeners to talk to me, which is that should any of them really care about my opinion of stocks, they can go to a website, sprottusa.com/rankings, list their natural resource stocks, please no tech stocks, please no cannabis stocks. I personally will rank those 1 to 10, including Australian listings if I know them. And I'll comment personally on any companies where I think my comments might have value. By the way, 1 in this circumstance has been best, 10 is worst. And I will include, for those who include charts in the question line, the Barron's Gold Mining Index chart, which is a 50-year chart, the most inclusive and longest running gold equities chart on the planet, and a 100-year commodity chart, which will show just how cheap industrial commodities are despite their run-up when you compare them with other asset classes going back 100 years. So once again, sprottusa.com/rankings. I'll rank stocks, I'll comment on some, and I'll include, for those who care, the charts.
Oh, fantastic, Rick. Thanks for that. I'll make sure these guys send their emails to you. Absolutely. Look, Rick, again, thank you. Stay safe, and look, I'm looking forward to our in-person coffee, and whoever knows, whenever that is.
Depending on your point of view, I can tell by your accent that if it was in the afternoon, we could substitute beer for coffee, and you wouldn't hold it against me.
No, but we'll just put it into a coffee mug.
I'm in.
All right, thank you, Rick.
Thank you. Pleasure visiting with you.